Good evening, everyone. Yes, I'm back. Topping our news tonight, another positive day on Wall Street as investors were able to look past the Russia-Ukraine conflict and the escalating tensions in Iraq. Good news, right? Well, not for many investors. They're puzzled about how and why stocks can keep going up, avoiding the correction that so many have predicted after a 5-year bull run. And with political turmoil and economic uncertainty all around the world, the rise in equities has confounded the experts. Here's how the major averages ended today's session. The Dow rose 16 points, the Nasdaq up 30, and the S&P added 5 points.
Unnatural. That's how Mark Lucchini, chief investment strategist at Janney Montgomery Scott, describes a stock market that hasn't experienced a 10% pullback in 3 years. So, would investors be on firmer footing if there'd been a wicked sell-off or two? And do stocks need to correct before they can move reliably higher? Mark Lucchini joins us now, as does Jack Ablin, Chief Investment Officer with BMO Private Bank. Gentlemen, good to have you here. Mark, let me just start with you. Do we need a pullback for the market really to be healthy?
I don't think we need a pullback, Tyler, at least not in that vein. Certainly, like many, I would welcome one because I do think it would re-energize equity investors at more attractive valuations than exist at the moment. But there's no immutable law that says we have to have a correction defined as a decline of 10% or more. In fact, over the last 34 years, while 19 of those 34 years, there has been a correction of that order of magnitude. It hasn't obviously been 100%. And so as a consequence, I think as long as we continue to see the economic and corporate fundamentals improving, that should allow for stock prices to advance commensurate with earnings growth. And so I don't think we need to have one in order to invite continued interest in equities.
Jack, you are of a different opinion. You think we do need a correction in the stock market. Tell us why.
Sure. I think that there are a lot of investors sitting on the sidelines because valuations are expensive. Now, I think Mark is right. If as long as earnings can outpace current valuations for a while and revenues can outpace them, perhaps we could move forward without a correction. But I think the fact is that with valuations expensive and the economy doing okay, we could use a pullback to get some of this cash that's sitting on the sidelines into the market.
So that's the good side, Jack, of a market pullback. In other words, when valuations go down, it attracts more money in?
Yeah. So, I mean, I can, in our own case, I mean, if someone were to open an account with us today and give us 100% cash, I would have a difficult time buying certainly small caps. I wouldn't touch small caps at these levels, and they've already had nearly a 10% correction. But large caps, I would have to really be careful and pick and choose, where we would go. I certainly would not just make a lump sum allocation to equities at this level.
Mark, a lot of people are keeping score of how many days it's been since we've had a market correction. It's something like 1,000 plus. If you look back in Wall Street history, there have been periods that have gone even longer than this without a correction. So, just answer the question, is it bad or is it good not to have a correction?
Well, I think it's good not to have a correction as long as equity prices continue to be supported by the fundamentals. I think, on the other hand, Susie, it would be bad if we saw a melt-up in equity prices in the absence of cooperating fundamentals, which drove valuations to egregiously high levels. And while I mostly agree with what Jack said, I will differ, is I don't think valuations are all that expensive. I think valuations in the U.S. equity market at about 15 times, a little more than that, perhaps, forward 12-month earnings are full. I wouldn't argue that they're expensive. And as a consequence, particularly given the lack of alternatives in bonds and cash for risk-based capital, I think equities can go higher without the need for a corrective phase.
So, Jack, it seems like there are a couple of things that may have sort of changed the equation a little bit. One is that the period of high liquidity, of easy money, does seem to be changing. The Fed certainly is cutting back on the bond purchases and likely will raise interest rates next year. There is heightened geopolitical concern around the world. How likely do you think a 10% pullback is in the market over, let's say, the period between now and the end of the year? And what would you do? Where would you put money if one happens?
Sure, it's entirely likely. I think that, that I agree with Mark. Through the lens of bonds, stocks do look cheap, but that is the only lens in which stocks look cheap because profit margins are near all-time record. If you relative to sales, just the revenues, stocks are probably 25 percentage points above their median levels. So if we do get a continued pullback in liquidity, which I believe has been the driver of the market over the last 12 to 18 months or so, it's entirely likely we'd go to cash and sit it out. We watch liquidity in credit spreads, and we watch momentum in just the market action itself. And that could prompt us to reduce our risk and go to cash.
A spirited discussion, gentlemen. Thank you very much. Mark Lucchini with Janney Montgomery and Jack Ablin with BMO Private Bank.